Hello and welcome to another episode of Modern Business. So Modern Business Accounting Principles, and this week we are up to chapter 11, which is the profit and loss statement, which nowadays we also call the income statement. If you haven't seen the intro to this series, this book is from 1937, copyright Alexander Hamilton Institute, and was published to be an alternative to schooling education. So people didn't have the opportunities that we have today to go to business school to learn about business, so the Institute published these books as a how-to guide to help businessmen specifically, and the books are written for him, but I do change those to for her. So let's jump into the profit and loss statement, and it goes through some specific examples that it's used throughout the book of this particular company, because learning accounting honestly is so much easier with an example rather than just theory, and a lot of what you do in accounting is example based. So the statement of profit and loss, or the income statement, presents the information concerning the income of the enterprise on one side and the expenses incurred in producing that income on the other side. Now, it is referring to debits and credits, and the first example given are of a left and right debit and credit arrangement, which is not really what is used these days. We use the long form, so the one that flows top to bottom rather than kind of left to right in sections, but it is interesting the way it is presented. So the profit and loss statement shows all the items that were included in computing the net profit. There were only a few accounts used in the illustration, and however, in a larger enterprise, there would be a number of income items and a great many expense accounts. And how many income accounts and expense accounts you have in your business really is mostly up to you. How detailed would you like to be? How useful is that information? For example, is it important for you to separate business card printing from flyer printing, from printing packaging? If that information is useful to you, then track it. But if that's too much detail and it's too confusing and you can deal without that detail, then that is up to you also. So it says you can get a number of different levels of profit and loss, which is a really good example of digging into your information. So they call this subdividing the profit and loss statement. So a manager usually wishes to have the statement of profit and loss presented in sections, which will enable her to make comparisons of costs and income from different divisions of the business. Now, it's not just for different divisions of the business, and this is something that comes a little bit later in the chapter, but also for different aspects of the business. And this is something I really advise my clients to do, is to separate the different ways in which money flows into their company to be able to track how those aspects perform. So this is the example given, and you can see the left and right arrangement with the profit and loss statement, and we flow through a number of different categories. So the categories they have are trading. So trading is what you made in sales, less what those sales cost you, cost of goods sold, in which we look at purchases and stock on hand and any opening inventory as well. So there's a way to calculate cost of goods sold that's kind of recreating the accounts if you don't have that specific information, and that's something you would need to work with an accountant or bookkeeper on. The second section that's presented then are selling and administrative costs, and these are separate from cost of goods sold. So something like postage to send an item to a customer is a selling expense, not a cost of goods sold expense, and that's quite easily confused because it seems like a cost of goods sold, but it's not. It's a cost of making the sale, not of cost of producing the goods. Then they also have a financial section where things like interest and dividends, discounts, bad debt, that sort of thing comes in. And I suggest that's not really that prolific in the handmade businesses I deal with, but in big businesses there would definitely be a financial section. So it goes on to tell us that when we refer to trading here, really they are calculating the gross profit. So this is your cost, income from sales less the cost of the goods that were sold, not the cost of making those sales. That comes next. The second is operating profit. So this is obtained by deducting the selling and administrative expenses from the trading profit, or the gross profit, as we would now say. Then in the last section, the financial section, leaves us with the net profit, where you also add in exceptional income and expenses. So if you sold equipment for a loss, sold equipment for a profit, that sort of thing, those would come through in exceptional income. And you do want to be tracking anything out of the ordinary sales wise in a separate account. So if you do have equipment that you have sold, that shouldn't be confused with your regular income from selling products. You do want to be tracking that separately, else you're going to be confused when you come back to compare that in a future period and you're like, why was my income so much higher in this particular month? Or why did I make a loss in this particular month if you have sold equipment for a loss? Then we go on to talk about subdivisions of the trading section. So in the illustration above, all the sales were shown in one sum and the trading profit was computed for the business as a whole. It would be a simple matter to determine the gross profit of classes of merchandise if sales and purchases accounts were maintained for each line of goods handled. So in the example, they have different levels of furniture, different trading locations, that sort of thing. That's all very useful. So there's a number of different ways to split this for a handmade business. So maybe you track your Etsy sales separately from your own website sales. Very much a recommendation from me. You want to track your market sales separately from your online sales, and you want to track wholesale and consignment separately as well. And depending on what level you would like to go through to, you might put each wholesale account in, you might put each consignment account in, and be tracking the income from those quite specifically. The trading section of the profit and loss statement in that case would be divided into many parts, as there were lots of sales to consider. Now, I don't necessarily suggest that you put different products, because probably selling one main product, and it's more important, or normally is more important, to track where your sales are coming from, the channel they come through, rather than the actual different product you sell. But you can, if you sell quite separate products, you can go to that level, but you're going to be doing a lot more data entry around what it is you are selling. There are also ways to give a simplified form of profit and loss, just depending on the target audience of the statement. So if you think about big businesses, they don't necessarily want everybody out there seeing their full profit and loss statement detailing every single thing they sold, how each of their divisions are operating, how each of their locations are operating, what their most profitable product line is. That's not the sort of information you will necessarily want to share with the world. So we go to these more simplified versions that people can see, to give them enough information, but not to give them inside information. So it is possible in this simplified form, and it's not necessarily just about the information within it, but the way it's presented. So the way it's presented, probably more currently than the debit and credit version, is this way, and we use the form version. So starting with net sales at the top, deducting cost of goods sold, etc., going all the way down to net profit. So we've got selling and administrative, and then we've got finance expenses in there. And that would be the statement you're more used to seeing from your bookkeeping software, because that is the widely accepted statement. So to go back to the top of the statement, after we have net sales, we have cost of goods sold. So the cost of goods sold is obtained in this case, and in many cases, by subtracting the stock on hand at the end of the period from the purchases made during the period. And then to know, had the business been operating for a period prior to the one under consideration, the cost of goods sold would have been arrived at by adding the previous stock to the current purchases and subtracting the stock on hand at the end of the period. It's a very complicated way of saying First, you start with the inventory you had at the beginning of the financial period. You add to that purchases made during the period, and then you deduct the stock available at the end. And I do have a blog on my website about cost of goods sold, and it is something that confuses people. What's included in cost of goods sold and what's excluded from cost of goods sold. It also feeds into pricing. So how does pricing work in terms of cost of goods sold? That sort of thing. How do you allocate it? What method do you use for allocating costs? There's all sorts of considerations that go into it, but they're very important in actually measuring the profitability of your business. So it is worth spending the time doing that properly. And then after some more examples, we just go into the advantages of the report form. So the reason that people stopped using the debit and credit version was because people didn't understand debits and credits, whereas everybody can kind of understand the report version because it's sales, less cost of goods sold, and income from selling and administrative, deduct expenses, and it's much more easy to understand. So it's a distinct advantage over the account form of being much clearer. A person can start at the top and read straight through without requiring any outside explanation of terms. It constitutes a complete historical record of the business operations arranged in logical sequence. And it's possible to see at a glance just how the income from sales has been used, and that's effectively what a profit and loss statement is for. What has been the income and how has that income been used, and what's the difference, the profit at the end. Another advantage of equal significance is the ease with which comparisons can be made. A manager judges the process she is making by comparing the current operations with those of preceding periods. When the statement is prepared in this form, so the report form that you're used to, she can place a whole series of statements before her and glance across the page for comparison of like items over a considerable period of time. And that is something that's useful in standardizing your bookkeeping, using the same names constantly, not changing from material to purchases or from material to inventory. If you keep those same names kind of consistently, just adapting as you need to, not unnecessarily, you really can start to compare periods, and that's not just years. You can compare months, you can compare specific weeks. So how was the first week of December for you last year compared to the first week of December the year before, that sort of thing. So you can start to make those direct comparisons with the report format. Also, the statements that were shown here were of a simple trading concern, but the forms are used for a wide application. A concern that sells £500 worth of goods would use the same form of statement as one who sells only amount to a few £1,000s. Furthermore, it makes no difference whether the enterprise sells furniture or machinery. The arrangement of profit and loss accounts is the same. So that's one of the things in accounting, one of the main drivers is to make things comparable, not just for the business, but actually across businesses, across industries, across countries, so that things can be understood without having to relearn the same things in just different formats, different versions, different wording. And that is the end of the chapter. So profit and loss statement is an essential in running your business and understanding how your business is performing, how profitability is, what your income is, what your expenses are. Separating them into those key categories, so cost of goods sold, selling and administrative, either together or separate if it's easy for you to track, and financial, which are maybe probably not going to be too significant in your business, will allow you to see where your income is flowing to. Are you spending a lot on selling? Are you spending a lot on admin? Are you spending a lot financing loans? That sort of information will really come from your profit and loss or income statement. Next week we have the balance sheet, which will be another interesting topic for the Modern Business series. If you like this video, please like, comment or subscribe. Otherwise, I will see you here again next week.